All right, so like Andrew said, I have Mark Mahaney with me, who has been covering internet stocks for 20 years, currently for RBC Markets. Next to him, Brett Thill, who's been covering cloud and enterprise stocks for just as long, but he just started covering internet stocks at Jefferies. So they're going to tell us which stocks we should all be buying and shorting and selling. But first, I want to share a little context about the markets. So 40% of the S&P's 500 market cap gains so far this year have come from just 5 stocks: Apple, Amazon, Facebook, Google, Microsoft, and Netflix. 85% of the market cap of internet stocks is owned by 3 companies. And out of the 13 US IPOs this year, a fourth of them are underwater. 60% of investors in a recent Wall Street Journal survey said that tech stocks are expensive, and 20% think that they're bubble-like. So I want to start. You're cringing already on that, Mark. All right, I want to start with you, Mark. You started the year by saying that the FANG stocks, the ones that I just named, were going to outperform for the 2nd year in a row, and so far they have. How long can this streak go?
It'll go as long as the fundamental trends remain really strong. So Netflix came out today and posted subscriber numbers that were materially above the street, and the stock's up 10%, and they added, I don't know, $7 billion in market cap in the aftermarket. So yeah, if the numbers are better than expected, then the stocks go up. And the fundamental trends of these names have been extraordinarily consistent. Like, I just always throw these numbers out. We've got Facebook 16 quarters in a row of 50% year-over-year growth. I don't think we've seen that before. Google has gone 29 straight quarters of 20% year-over-year growth. At that size, this is an 80 billion run rate company. You rarely ever see that. And I got 2 other names for you: Priceline, Glenn Fogel, and Amazon have gone 40 straight quarters with at least 20% year-over-year growth. So you do that, and these are like secular growth utilities without the regulation, except that's starting to come in. That's one of the risks.
And we'll talk about the regulation later. But
with those kind of fundamentals, stocks will keep going higher.
Brett, thoughts?
I agree with Mark. I mean, if you look at Amazon, we look at the AWS business as an enterprise guy and forecast out. We think this is potentially a $50 billion business. You put a software multiple on this, and then you put a 1.5 or 2 multiple on the rest of Amazon's business. I mean, it's going to have a $750 to $1 billion market cap just on that what-if scenario when you look at these numbers. Google's trading at 12 times EBITDA versus Amazon at 20. So you look at there's multiple potential expansion for Google relative to what's happening. Everyone's talking about Amazon right now.
All right, so we obviously have 2 bulls here, disagreeing with the 20% of Wall Street Journal readers that think that stocks are bubble-liking. Let's take the opposite question here. Which of these stocks is most likely to have a correction?
Of the major, and by the way, I want to throw out a new acronym. I think it's PE-FANG. I think people so long have underestimated Priceline and Expedia. I think we should refer to the and consumer internet, and then leave aside Microsoft and Apple. I don't cover those, but I think there are at least 6 high-quality assets. And by the way,
that's not very catchy, though. Can we work on that?
Yeah. Well, I'm working. But then the other ones, there are some names that we've been pretty cautious on for some time, or some we have a sell on. Twitter. eBay, TripAdvisor, and we're not talking, by the way, about eBay. 10 years ago, that would have been the poster child of great tech stocks, and Yahoo 15 years ago. So there's a lot of risk in this sector. We just happen to be doing the winner's curse here today. But there are plenty of stocks that haven't done as well. Of those, let's do of the major 4 FANG, which has probably got the greatest risk. I'm going to throw out a little. I think it's not a consensus idea. I think Google is, because the biggest new competitive risk for all of these names is government, and they're the furthest down the sights of any one of these companies, and they're going to have to change their search. They may have to change their user interface, and that means that could hurt their consumer satisfaction, utilization, and eventually profits.
So we've seen that in Europe. Are you expecting that to happen in the U.S.?
I mean, if somebody has a name of a company that appears more monopolistic than Google, let me know. With that kind of market share, and by the way, I don't mean that they've. I kind of disagree with what the part of the European Commission position was, that they wouldn't consider Amazon as a competitive search engine. It absolutely is. But anyway, I think they made a mistake there. But it doesn't matter. I'm not saying it's right or wrong. I'm just the regulators are coming, and a company with that kind of market share and the ability to negatively impact market shares of competitors, it's rare to see a company like that.
3 sell-rated names from Jefferies have been IBM, Intel, and Citrix. So those are the 3 that our analysts believe are underperform.
Mm-hmm. And so, wait, sorry, can you elaborate on that?
Well, I think when you look at what NVIDIA is doing to Intel, I think our analysts, our semi-analysts, has been very bullish about what's happening in that shift, and you can see it in the stock. Intel's down year to date, NVIDIA is up massively. Citrix obviously facing some legacy challenges, and then IBM also the same challenge relative to what's happening with AWS.
All right, so I want to get back to this question of antitrust because it's not just that. I think that there's a possibility that there could be a backlash to the so-called frightful five. That's what people are now calling these companies. I mean, do you see a potential of there ever being a consumer backlash where people are just saying, I am tired of my life being completely dominated by a handful of tech companies?
No. I mean, what drives...
Can I ask the audience, are you guys freaked out by the fact that 5 companies dominate almost everything in our life? Anybody?
Absolutely.
All right, but and are you invested in any of these companies?
I think most consumers and kind of think about are these companies making their lives better, and I think that the reason that Amazon has the market cap it does and eBay has the market cap that it does has to do with which one provided a more compelling long-term value proposition, making it faster, cheaper. They're doing something for consumers that nobody had ever done before. Help them avoid Main Street robbery. I think Google has made it easy for people to find information anywhere, anytime. I mean, what a wonderful gift, for consumers, and it's a free service for consumers, this thing called YouTube. Facebook has brought 2 billion people around the world together. Like, consumers have kind of voted with their feet, and then investors have kind of caught up with their pocketbooks. I don't think there's a consumer backlash. It's just like this ongoing concern about Snap Maps, all these privacy concerns. I think we're kind of post-privacy, and I certainly think anybody under 30 is probably post-privacy and certainly willing to make the trade-off. So I don't think there's this consumer backlash coming.
All right, so you named 2 names there that I want to talk about: Snap and Amazon. Brent, you have called Amazon a runaway freight train, and the market sentiment is clearly that a company cannot lose in anything. But my instinct is always to push back on unanimous hype. So please tell me why I'm wrong.
I think we come from a commercial angle. I was a software guy for 20 years, and when we ask private companies and public companies who they're basing their technology on, it's Amazon, AWS. The same thing is covering internet names now for the last few months. You go to every internet company, even the companies that are trying to compete with them, like Chegg, who did college textbooks, Data Online, they're now all going to AWS. So I think it's universal, and if you look at that, once you put your data there, you're not getting rid of it. And that recurring revenue stream is exactly what Amazon has. It's what the software industry's had, and that's really unique, right? The retail piece can be a little more volatile.
So you guys both strong buys Amazon.
No, we've got a buy. I'm not a strong buy. There's unfortunately, I love the expression screaming buy, and for me, it's I say buy and the client screams at me. And that happened, a year and a half ago with Amazon, and last 5 years with Netflix. And now it's kind of like so it's hard to pound the table.
Wait, and did you say "told you so"?
No. I've made plenty of mistakes too. These stocks, I've covered internet for 20 years. The sentiment on the group has never been more consensus. Now, there's a couple of really controversial ones like Snapchat, but the leading market cap names have never, they're all at all-time highs, so is the market, but all of these have led the market to all-time highs. So it's actually a little bit boring.
All right, so let's talk about Snap. Who in the audience is shorting Snap?
Shorted Snap?
Oh, just one? I feel like every investor I talk to says they're shorting Snap. Maybe you just don't want to admit it. All right, so analysts do not like Snap. Currently, the market does not like Snap. Mark, you are a little contrarian there. Give us the bull case for Snap.
So it's broken below its IPO price. When the stock was at $24, I put a buy on it with a $31 price target. So what do I know? But this is the pitch, and it's way out there in the risk spectrum. If you want less risk, you'll sleep better at night, go long Facebook and Google, et cetera. But Snapchat, I think this is some of the best product innovation on the internet today. And I'm not the only one who thinks that. So does the Instagram team.
Ooh. Flames emoji.
and the Facebook team, but that's fine. And I did mention this Snap Maps. I didn't mention that just by accident. I thought that was really fun and interesting what they came out with. And I've got 3 teenage boys at home, so I'm an expert on Snapchat. I think the level of innovation really has been very impressive that comes out of that company. And there's no doubt at all that they're dramatically under-monetized versus Twitter and versus Facebook. So they're not going to be the next Facebook, but could they be quarter of the size of Facebook? And are they doing a few things to get there? I think they are. And I think the market is so negative on it. Yeah, I'll take the other side. And this is, very asymmetrical. I think you got, 15, 16. I think for a variety of reasons, there's some valuation support there. And if I'm right and there's a fundamental inflection point, not now, but at the end of the year or early next year, I mean, this thing's a double. And I can't say that about another stock in the large cap internet space. So Yeah, I'm here. I'm here. I'm a bull on Snap. I'm about the only one.
All right, right, all right.
I'm not quite as bullish as Mark. I think they've got some short-term challenges with the lockup, with the ability to move from proven advertising on Facebook to this is experimental for a lot of companies still, and I think they have yet to work on the user interface. I'm still trying to figure out the UI myself, and I was a UI guy for 20 years in software.
Gotta get those teenage sons,
I think So I think there's a few short-term hurdles I got to get through, but.
All right, so you had also talked to me about you're really bullish on a lot of small cap stocks.
I was, but we're actually more defensive now, small cap. Small cap is actually the Russell 2000s trading at a 25% premium to its historic average. Mm-hmm. So if you look at that index, it's only up a single-digit percent this year versus other names in the internet up 30, 40%. So I think the small cap index right now is our market analysts believe it's overvalued, mm-hmm. and we're become a lot more defensive. All
right, what about anything in the pipeline? Are you excited about any of the percolating and rumored IPOs?
In the private pipeline?
Mm-hmm.
Yeah, I mean, I think, again, with no intentions of plans, but I think everyone is excited for Airbnb and what's happening there. I think there's a handful of other names, whether it's Pinterest. There's a lot of names we could go through, but I think those are two of the bigger ones that are of interest.
All right, so let's go to some audience questions. Who out there wants to, let's go right in the back there.
Hi, my name is Hamid Faruqi. I'm the CEO of Sogo Survey. Why do you guys not talk about NVIDIA? I mean, has it not? I mean, it's one of those stocks that's gone unnoticed, and in last 1 year, I think it's gone from $50 to $160.
So Mark and I worked together at Citi. He was the internet analyst. I was a software analyst. We've worked together for a while, and now compete, which is great. But I would say that we're just doing software and internet. That's what we've done.
But you have previously covered.
We don't have representations from the semiconductor or hardware industry here on stage. So yes, software and internet related questions I think are probably the most.
And what do you guys think of Twitter?
All right, Twitter, go.
Okay, so I've been relatively skeptical and pretty vocal about it. Now, it's possible the way the stock is acting, I may be wrong on this one too. We've had a nice recovery in the shares. I saw, call it year to date. But I think this is a company that really suffered from lack of innovation, dramatic management turmoil.
So what's the stock up on now? Why is it up?
There's a little bit of M&A speculation, and I think that they floated that ship and nobody boarded it. Did I just ruin the analogy? But that doesn't mean that somebody couldn't do that in the future. So it's an expensive stock. It's got a year-over-year decline in revenue. I'm sorry, their ad revenues are declining in a secular growth industry. That's screwed up. I mean, that tells you that something's wrong. Doesn't mean it can't be fixed. And I use Twitter all the time. Like I see a lot of things they're doing to make the site more relevant. So that could improve user growth. If it does, then the stock could go higher. But until I really see that evidence that user growth can sustainably reaccelerate, I don't think it's a buy. Not at this price. I think it's a sell.
All right, question out there. All right, let's go back to the unicorns. You mentioned you're excited about Pinterest and Airbnb, but the two consumer unicorns that went public this year, Snap and Blue Apron, have done terribly. Why is it that these two are just not the right companies, or are investors just generally kind of not excited about overvalued private companies?
I think to start Blue Apron right, it was a series of bad things that flew up in front of them with Amazon entering. And today they mentioned there's a handful of trademarks that they're taking out on meal kits and delivery. So the news could have gotten worse for them. So that was just bad timing, in my opinion. Mark?
I won't comment on Blue Apron, but on Snapchat, they missed a good number of the estimates that were out there. So you miss estimates, stock goes off. It already had a high. I mean, it was with that kind of multiple, you can't miss estimates, and they did. And then obviously a lot of competitive risk, which you sort of saw coming. Well, it came, and you had a lot of features and aggressive moves with advertisers, that were taken by Facebook and Instagram. Nothing wrong with what they're doing. They're doing a great job, but it's negatively impacted Snap's growth rate. So they got to stabilize that.
Growth aside, are investors tired of letting every single company, even the ones that aren't outperforming, have 3 tiers of stock and complete control of the board?
Investors would prefer that there not be super voting shares, but it's great to be king. And the owners of these companies and the people who've built them with their own sweat and et cetera, they can do what they want, and investors can decide not to participate if that's what they want. By the way, I just want to make one comment on the private markets.
There can't have a company like Snap is big enough that it's listed in indexes. They end up investing.
Actually, you're right. Okay, I would correct myself. But just real quickly on these, without commenting on any of the private companies, one of the things I do want to make the point of, there's this sense out there that the public markets are so short-term oriented and the private markets are long-term and more mature. That's not true.
I feel a rant coming on.
Yeah, this is a rant. That's not true. If you look at the multiple of Netflix, the market certainly isn't short-term oriented on that because it trades at 100+ PE multiple. Amazon is traded at huge multiples, and it's because over time, but only over time, investors have become convinced that there's a good strategy, good execution, and they're willing to go out multiple years and discount back and say it's still a buy. So for companies that are considering going public, this is my pitch. I think the public markets can show a lot of patience if you execute really well.
And so we're going to be talking about that on Wednesday morning in our IPO breakfast. Hopefully you'll be there to give that advice as well. We have one more question back over there.
Sure, Glenn Kacher from Light Street Capital. Just want to ask you a quick question. If you drew a Venn diagram between the two of you and where you've historically focused, there's the skinny little banana part that seems to be small business, e-commerce. And if you look at Shopify, Square, Stamps.com, Wix, you see these online services that are creating these massive platforms. Do you guys have a comment on those stocks, and how do you feel about that trend?
Yay or nay?
Hey Glenn. We have a small business basket. We have for a while. GoDaddy is one of them on the side. Shopify is a fantastic asset. I've been a long-term bull on Intuit. Just a fantastic business. Stock is done very, very well for investors over a period of time. So I think the small business basket is one that we're very bullish about because it's being not noticed by the big gorillas. So yeah, we're very bullish about what's happening there. I would caveat again, some of the multiples there have come up pretty aggressively. So buyer beware here, given the recent run.
What about the other one he mentioned, Wix, and then what was the last one? Stamps. You don't cover this?
I don't cover Wix or Stamps.
All right, let's do a quick rapid fire. I'm going to name some names, and you guys can just give a yay or nay. And people, get out your Robinhood app or whatever you use to buy and sell stock, and we'll, move some markets here after hours. Etsy.
No comment.
Not sure. That's the honest answer. Not
LinkedIn.
Part of Microsoft.
Do you think that was a good acquisition, by the way? Yes or no?
I do think it was a good deal for Microsoft.
You do? For whom?
And they've done a terrible job with acquisitions in the past. But
Okay.
I think it's a great deal for Microsoft.
It was great for LinkedIn. That's what I think.
All right, Pandora.
Dominic's in right there.
Well, every time we run an annual survey, we've done it 5 years in a row. Like, I'm surprised by how sticky the move. People aren't necessarily streaming over to subscription-based models, and so Pandora should be bigger than it is today. And I don't know, Dom. I just. We got some management turmoil. That I'm never a big fan of that, and I think there have been some missed opportunities. So we're on the side. We don't recommend it as a buy nor a sell. We're on the hold on it.
Yelp.
I was a bull on that last year. I was a bull on that beginning of this year. Corrected and missed 2 quarters in a row. Boy, the one problem with small businesses, as somebody was asking about, is just damn hard to scale against those businesses. And so you got to hire all these 25-year-olds straight out of college or a couple of years out of college, and they got to man the phone banks, woman the phone banks, and that you get a lot of execution errors, and they've had 2 in a row, and I'm just worried about them.
Our team's buy rated.
Yeah.
They've had a massive. It's one of the only internet stocks that's down year to date. Mm-hmm. They had a fumble in sales. They had a fumble in contracting. We think those cleared up. So yeah, not a great.
Contrarian there. All right, one more since we had the CEO on stage literally minutes ago. Qualcomm.
Don't cover.
No cover.
No comment. All right, I'll end it there. Thanks a lot, guys.
Thanks, Aaron.